I'm releasing my credit spread 80 plus win rate formula today. We've been tracking this inside the Discord for a couple years, and we've proven out this system in front of thousands of traders. So if you comment the word spread, I will send a PDF straight to your inbox on how we're cranking these trades over the past couple years. And I'm not going to lie, traders, selling options has truly helped me replace my income. I used to be a trader with options like you, trying to hit 0-day trades, and it wasn't working out. I'd have a great month, my account would be up 500%, and then I'd have a bad month and give it all up. But when you stack gains with selling options, you don't have to look at the computer. It's more passive and it's less emotional. So if you want to really replace your income, you got to learn how to sell options. And once I got over that fear of not knowing what to do, being scared of what everyone was saying, that's when everything changed. Here's a bunch of screenshots of over $50,000 of gains, and I got another $5,000 this month I'm trying to see play out. So inside this video, we're going to release what a spread is, the 101, an example of it, how to enter it, my 80% win rate formula for choosing them, 4 places to enter spreads, and lastly, I'm going to tell you why I hate them. Because I stopped trading spreads 2 years ago, and I will tell you exactly why at the end of this video. But that doesn't mean it's not for everybody. So if you guys want one-on-one coaching, we help traders sell options and get closer and closer to replacing their income. One dude inside the Discord followed me to the T on my Tesla plays and made $12,000 in one single day. Imagine what you could do with me over a full year of private coaching. Apply in the description of this video. This is not something we launched to many people, just a select few. So credit spreads, let's go over it. Number one, what you're doing is you're shorting an option. For example, you start the trade by shorting, let's say the 516 call on SPY. When you sell an option, you always want to sell it out of the money. So for example, the price of SPY is 512, which means if you were to sell an option, you would go above it for calls and below it for puts. This gives you an out of the money opportunity with a 77% chance of profit. So if you sell this option for $140, if you had a covered call scenario, you'd be making $140, but it also ties up around 50 grand of collateral. So for those out there that don't have 50 grand of collateral, this is like the small account hack to sell options and create insane passive income. I'm talking double your account in a couple months passive income if you follow the formula correctly. So instead of just selling an option and then being done with it, in order to be able to do this for a small account, you have to buy an option at the same time. So it's selling and then buying. This creates that credit spread. And so what you would do is you would buy an option higher if you were doing calls. So if you were at the 516 strike for short, you'd long an option 518. And this is trading at $84. And we'll show you why this is significant right here. But when you put these in at the same exact time, we'll show you how to do this in a second. You short one, you buy one, and then you collect the difference. So you're hoping to have a net negative position because the one you're shorting is higher. So the more of a difference it is, the more you can collect in passive income. And you want to make sure you have these out of the money, and then the more you can collect, the higher your income can be, because most options are going to expire, go worthless. So if you apply our entry and exit system, we'll tell you at the end of the video, you're going to be able to crush credit spreads on a daily or weekly basis. The one thing you got to understand is that these credit spreads, they're going to be more loss than gain. What I mean by that is you're trying to make typically a 1 to 3 risk to reward. And that's like I would say that's the riskiest scenario. You could go 2 to 1, that's even riskier. You could go 1 to 4, you make less money, but when you lose insanely big. So I like the 1 to 3. We'll explain why in a second. But this means every time you lose in the credit spread trade, you're losing $142, but you're trying to make 58. So that is what you need to understand. The downside of spreads is that you lose more than you gain. So when your win rate's that high, You just have to understand the losers are going to cut harder. So when you put in this trade, this is what it looks like. Sell one, buy one, and then you try to collect the premium. And so what happens is over time, that premium decays and goes into your account. People think this stuff goes into your account instantly. They're wrong. Their brokerages are calculating things that are going to put you in a bad place. So you got to make sure you don't have level 4 options, or else they might do some sketchy stuff. But for example, this option I would sell for SPY would be like 5 days out, 1, 2, 3, 4, 5. And then if you sell the 516 call, you buy the 518 call, you have a 76% chance of profit. So think about it. You could be an absolute dummy in the markets and have a 70% win rate strategy. So that's why I like selling options. It's just insane. So you're collecting this premium. This is the margin required. It's the difference of the strike prices. And then your max loss is the credit minus the margin. That's the max loss. And how you win, the scenarios of what happened is you can be wrong of direction and you can still make money, which I'll show you in a second. You can be right with direction. You make money faster. You could be totally wrong. That's where you lose money. So that's where you want to be nervous about being totally wrong. The best part is you get paid passively. So if I pull up the chart here, the risk to reward and the profit per day is shown down here. Every single day, you're just collecting money. So if it's Monday here, the market opens, you're making 15% just for the market opening. I mean, can you imagine that? Just waking up to money? I mean, that's the beauty of selling options. And everyone's afraid to do it. But I mean, what other passive income sources are people waking up to 10% returns to on a Monday morning? Probably minimal. I'd say zero. So if you wake up on Tuesday, guess what? That 15% goes to 30. You collected almost 1/3 of that $60. And then a third day, if you wake up and the market's flat for 3 days in a row, you've collected half. And then eventually on the last day, you collect it all. The beauty is if you go down, the market drops, you collect it faster. So if the market were to drop on Monday from 511 here to let's say 507, you'd make 80% return on your credit. So you can close these things early. You can get out, recycle your money pretty quickly, which is also the beauty of it. So for example, this is kind of random why I put this on, but market did hit a pretty good level of resistance at 512. Let's say it's according to our entry system. We'll show you in a second. If you were to sell the example I just showed you, you short the 516 strike, you long the 518 strike, and in that case, you're green anything under the break even. So break even is 516.50. So the beauty is the break even is where you add your credit to your short strike. So your break even goes a little bit higher than the short strike, which is nice. So if you're under 516.58, you're making money. And more importantly, the stock could go down. You make money faster when it goes down. Boom. Drops on Monday, you get out, close that thing. Once you hit 80% return, get out. If it goes up, if you're wrong, you're still good. You're still gravy, as long as it doesn't go into 516.58. Once you hit that, you're kind of going to see red soon. So it could go up. It doesn't need to go up that fast. If it goes up slowly, you're good. As you can see here, the market could literally rise slowly per day. You know, we go up to 513 the next day. We go up to 515 the next day. You're still moving that break even higher. You see this break even line, how it trends up as expiration goes? That means that the market can trend up too, and then you're basically not losing money in this play because that time decay is clicking away for you. Once you pass 516.80 or 58, you could close it out early. You could wait till expiration, see if it comes back in. You can roll the options. We have a bunch of videos on how to do the last half of managing the trade, but we're just doing the intro stuff today. So now I'm going to go into Robinhood and show you exactly how to input this, and I'm going to show you exactly how to exit it. So first things first, we're going to show you the full formula on the next couple slides, But I want to go over on Robinhood what to do here. So if we were on SPY for a call, if we want to do a call credit spread, you got to short the first option you pick. So sell, call. That's how you start the trade. And we're going to go for, let's say, 5 days out for reasons we'll talk about later. So that's important. And the next thing we want to do is just pick the strike price. Again, we'll show you the formula later. Around 516 is what I chose earlier. And then you want to be buying the option next. So 516 is inputted. It's called a covered call at this point because we don't have the long option as collateral yet. We want to input that to make sure it's not a covered call. So if we go up here, 518, we click that sucker, you're going to see now it's a call credit spread. So when it says credit, that means it's going to into your account in the future. You want to make sure it doesn't say debit, or else that's what you're going to pay. So call credit spread means you're hoping to collect this money. So you click continue. You try to enter the trade around the 56, 57 mark. Basically, you want to get as much premium as possible, so the higher the better, but you won't get filled if you go too high. And so you could enter, let's say, 20 of these at 58. And this is, again, 5 days away. And you can make $1,000. 20 of them, $1,000. You're risking 3,000. Again, it's 1 to 3. So you're risking 3 to make 1. But it's passive. I mean, I don't know how many times I could say that. People think like it's safer being in 0-day options and just gambling every day. It's not. So the one thing you might do wrong is you might buy and then sell. And I want to point out one thing. This is a more aggressive way to be in option spreads. It mitigates time decay. It puts risk to reward higher in your favor, but it's a directional bet. So you need the market to move to make money. So you can see right now, market's at 512, and we need to go to 516.58 to start making money. So you could do debit spreads. They're aggressive, but you got to be super on point with when to get in and out. Lastly, if you want to do a put credit spread, what you're going to do is sell an option out of the money. It's got to be in these 70% marks, let's say 77, 75. And then you want to buy, let's say 2 strikes lower. This makes you $30. You're risking 160. This would not be on point with what we want to do with our system. So let me show you the system next. So let's pop in here. We're going to go back and show you how to pick the right spread. So before I go over that, here's a picture. You can snapshot it. I'm not going to go over exactly what it means, but this is a call credit spread and how it looks with the short call, long call, break even, and how you start making money. Put credit spread, short call, long call, break even. The point is you make money when it goes up for puts. You make money when it goes down for calls. It's kind of like opposite day. And now let me break down the formula, how to pick the right credit spread. So number one, you want to be going daily chart for when the trade gets triggered. I'm going to show you the right times to get in and out of the market and when to know when it's ripe for a credit spread in a second. But daily chart's important to trigger the trade with one of our entry systems. And then expiration date should be 2 to 10 days out. You'll make more money going further out, which I can show you here. So more time equals more profits. For SPY, this is our credit spread. It's 58 credit for the 510 strike, and that's 5 days out. If we go 10 days out, we add another 5 days. We're making 75. So more money, more time. So every time you go shorter term expiration dates, you're just trying to recycle that as much as possible, but it's tougher to hit good trades every 2 days. It's easier to hit a good trade every day or every 10 days. And we want to go 70% chance of profit. Super important. You don't want to be getting into spreads that have 65 or lower, just because when you lose, you're losing 3 times as much. So if your win rate is 80%, 8 winners, 2 losers out of 10 trades, those 3 losers could eat up like 6 winners. So especially if you mismanaged this not well. So you got to be careful. And lastly, 3 to 1's the key. If you start doing 4 to 1's, that's where like an 80% win rate strategy can be breaking even or losing money. So if you could go 2 to 1's with the proper entry, that's going to help you stay more profitable, but it's going to be tougher. Now I'm going to give you the 4 places to enter that's going to help you crush credit spreads. Number 1, fair value gaps with huge candles is super key. So in the market, we saw the fair value gap open on this massive dropping candle here, and we fill it on this candle there. From there, you would trigger a call spread. So anytime you go into a fair value gap higher, you would trigger a call spread when you close it out. So when you close the fair value gap. And if you don't know what a fair value gap is, it's just an opening of the candle that has never been touched by anything really. So this candle's wide open, and the middle part has just never been tapped by other candles in the future. So fair value gaps, you can look them up online, pretty simple. Or you want to just do open gaps. So open gaps are going to be like we saw. This is an open gap here where there's no body. We fill it. You could have put on a put credit spread. And then here's an open gap. We fill it. Then you could put on that one's tough because it's in the middle. You want to go kind of against the direction. So I like gaps, fair value, or even open to enter these spreads. I like double bottoms. I like when the market has a low and we tap it and we have confirmation. So the confirmation could be a couple candles supporting the bottom. It could be a hammer candle. It could be an engulfing candle at this low. Basically, once you hit double bottoms, you want to use those spreads. Market tends to not go through double bottoms as easily. It tends to respect lows that have been aggressive pullbacks in the market in the past and never tapped. So double bottoms or double tops. So in this scenario, you would do a put credit spread according to the formula here. 2 to 10 days out, 70% chance of profit, 3 to 1 risk to reward. It's super important that you just adjust the numbers, man. So if you're going 5 days out, you click that. If you want to go 3 to 1, what you got to do is adjust it. So if you go here to here, $246 credit, max loss is $654. That's like a 1 to 1. So I just drag this up. This is 155 to 545. That's like a 4 to 1. So I got to drag this down. 132, 367. That's a 3 to 1 risk to reward. So you're good. We're over 70% chance of profit. So that's a trade I would literally take. So that one's beautiful. The last 2 ways to enter in the market are through engulfing candles. So this candle is engulfing right here. It's engulfing the prior candle. Typically, once you engulf, the market will move for 2 to 3 days in that direction. And if you do see that happen, it's nice to put on put credit spread with that directional engulf. So if we engulf bullish, you do put credit spread. If we engulf bearish like here, you do call credit spread. And that's the third entry. In the fourth entry, this is where you're going to see like a hammer, or we can call it dragonfly doji when a wick is really, really, really long. But the longer the wick, the safer the bottom. So I like the hammer candles, the pullback candles, or even the toppy candles that look like this. This is super key for reversals, and the credit spread strategy is typically a reversal opportunity. So when we see this, we can put on that spread according to the formula. Now let me break down my honest hatred for credit spreads and why it doesn't mean you have to hate them. I just want to tell you my experience with them. So number 1, they're super slow. And in the past, in the Discord, we were doing like 30-day out spreads. They take 30 days, and the decay just happens a lot slower typically. More importantly, they're boring. Boring is okay, but these are just too boring. Like I'm making $50, but I'm trying to risk like 150. It's not worth the risk. It'd be fine if it was boring and I wasn't getting my butt handed to me every time I lost. But that's the one thing I hate is it takes one day to ruin the spread. So it's just too much babysitting. Basically, if the market trends in your favor, let's say you've made 60% of the premium. So if you got $60, you make like 50 of it. And that last $10, you're wondering, do I keep holding? Do I just wait to close it out? Do I close it out today? And then you hold it. And then the next day, the spread rips against you. You lose all that profit you gained. And then you start going red. I've seen it happen way too many times to count. The last premium is just so hard to collect. And it does happen where you just blast in against you and you lose it. You just lose that profit you've been trying to stack. And more importantly, just overall, because it's slow and boring, and the fact that the risk to reward is against me just makes this a bad system for me personally. So I got the capital to sell puts and calls, and I don't have to worry about, being leveraged on a play and having that risk to reward being 3 times a loss if I go backwards. So if you hit 3 trades losing in a row, that means you've given up like 3 months of profit, because it might take you 9 trades to get it back, which might take you a whole month or 2. So risk to reward stacked against me. Again, so much babysitting. Even when it's profitable, I got to worry about it. When it's not profitable, I got to really worry about it because of exercising. Yeah, the exercising thing. It's not the worst thing in the world to get exercised and assigned. Everybody thinks like it's worse than it is. It's not. Just call up your broker, have them close out the position. Don't exit the other side of the spread. It's pretty simple stuff. Other than that, everybody should give it a go. Everybody should try it, see if it's right for them, mainly because this can make you passive income with a small account. So everybody out there trading options, come on, you're buying things that have a 30% win rate. So why not try this strategy that has an 80% win rate or 85? That's all I got today. If you guys want to watch another tutorial on option spreads, I'll link it to the right of me. We don't trade these in the Discord anymore, but we do poor man's covered call. So if you want to join the Discord, head to the link in the bio. Peace.